Spirit Business FM, the morning drive with me, Tim Elliott. The escalating US-Israel-Iran conflict is raising fresh questions about the outlook for Gulf economies, of course. Energy markets are reacting. Financial conditions could tighten further, of course. And sectors like travel and tourism and real estate are watching particularly closely. But what does it all mean for the United Arab Emirates and the wider GCC? With some early insights on what to expect, my guest, Azad Zangana, is the head of GCC Macroeconomic Analysis at Oxford Economics. They're preparing to release their latest regional forecast this week. Azad's with me. Good to meet you.
Thank you. Good to have you.
Very good to have you here. Caveat, first of all, I suppose, Azad, reports like this take time to compile. There's been some tension surrounding the military build-up from some time, for a while, of course. But actual military action has to add an element, I guess, to your outlook. Just broadly to begin with, let's kind of set this. How are recent geopolitical developments shaping the economic outlook here in the GCC right now?
So initially, we had to sit back and think about what are the sectors that are going to be impacted from the disruption that we're seeing at the moment. And so naturally, we had to start making some assumptions about the degree of how serious the disruption is going to be, but also how long this is all going to last. Now, naturally, we're going to be wrong somewhere along the lines, with those assumptions, but we have to make them in order to come up with some of our numbers that, of course, our clients are asking for. So at the moment, we've assumed that the conflict, the most serious part of the conflict, what we're seeing as the blockage to shipping, to travel, most of that will probably last around 2 weeks from the start. So we're a week in. We think it could last another week or so. But we then expect potentially another 6 weeks of sort of tension and low-level disruption continuing for some time. So through that period, you don't see a full recovery in imports and exports and travel and tourism, in day-to-day activity necessarily. And really, we're trying to think about what does this mean for the individual sectors, for all these economies, and also which economies are, how severe is the hit to these economies, because they're actually very different in terms of their levels of exposure.
It's interesting because I'm kind of surprised in a way. I mean, I know, as you say, there is a caveat there in that we can't tell, we can't see the future, we don't know what's going to happen, and you have to make assumptions to offer some kind of guidance almost in a way. But that's a much, I was going to use the word rosy, that's completely the wrong word to use, but that's a more positive outlook than I kind of expected from you.
It's a moving target.
Than I thought.
Yeah, I mean, it's a moving target. And you're right, these things do take time to put together. So, I mean, the team's been working round the clock pretty much since last weekend, and we're only now just about to publish the numbers that we have.
Right.
And, we fully hold our hands up and say, look, if this lasts even longer, then we're going to be revising our numbers naturally. But it gives people a guidance as to the degree of the impact if it's only a 2-week serious conflict. Obviously, if it extends, it becomes worse. But it also gives you guidance about where the impacts are going to hit, which countries are impacted at this moment in time, and which are less impacted.
And I guess in your role, you're used to essentially running numbers, running scenarios, aren't you? So this is an extension of that, an unwelcome extension, but that's simply what that's what you do.
It is, but now that it's the central view, we have to spend more time going through all the details of our forecast, because we run very big macroeconomic models to be able to estimate not just GDP, but sectoral bases, international trade. We're part of a big global team of over 450 economists running this service.
Okay, so let's delve in a little bit deeper. Are energy markets responding in a way that materially changes growth expectations for the region?
For the region, it's not really a question about the price of energy at this point in time, because ultimately the price is responding to the inability of these countries to export. So normally, if you ran an oil price shock through our model, and oil prices jumped where they are today, $115 per barrel on Brent, that would be good news for the GCC economies.
Sure.
They're making more money, they're spending more on capital investment and so on. But the reality is that the Strait of Hormuz is effectively closed at this moment in time. Nothing is passing through. And so these countries can't take advantage of the higher prices. This is the real trouble that we're seeing. Now, some countries can avoid the strait. They can use alternative pipelines. Oman, for example, doesn't export through the strait at all. So they're not really impacted. They will benefit from the higher oil price. But the likes of Bahrain, Qatar's in a pretty bad situation, actually. Kuwait as well, to a lesser extent, the UAE, they can't just export everything through alternative routes. So at the moment, they're taking a hit. They're not able to sell in the usual way. So their energy sectors are struggling at the moment, and they're having to think about closing down production because they're running out of storage facilities, given that they can't export what they're producing.
Yeah. Does higher oil volatility ultimately in the long term hurt or help Gulf economies based on the scenarios that you're running in this report?
It doesn't help. Volatility in pricing never helps the buyer or the seller. At the end of the day, everybody wants predictability in terms of how much they're going to pay and how much they're going to earn. But also the ability to export, I think, is quite an important factor because, we have energy systems around the world geared towards receiving energy from the Gulf. And if suddenly supply is disrupted, they need to start thinking about, well, what are the alternatives here? We saw that a couple of years ago when the Ukraine-Russia war really got going. And suddenly mainland Europe couldn't import energy from Russia anymore. They had to seek alternatives. And that alternative ended up being LNG from Qatar. So you can see how that then led to a huge amount of money being spent on new infrastructure, developing that trade route. It didn't happen overnight. It happened because there was a structural shift in where Europe could import from. Now, we're not saying that this is going to last anywhere near long enough for countries to start thinking, actually, maybe we need to start thinking about where else are we going to get our energy from. But high energy prices and this kind of volatility does lead to producers and people that need to consume this energy start thinking about, well, what are the alternatives when things go wrong? Should we be thinking more about renewables, especially now that the price of oil has jumped so high? The relative price of renewables is even lower today. And it sort of encourages that shift that I think most people are expecting over the very long term.
Yeah. It's not as though there's a tap that you could just switch on and everything can change. Wouldn't that be lovely? Let me ask you about this current environment that we're in. What does that mean for government spending and for fiscal policy across the GCC in those very different markets, as you have already pointed out?
So some of the countries were under a little bit of pressure already, even going into this period. Some of them were running larger, should we say, budget deficits than perhaps expected. Saudi Arabia in particular, Qatar as well, at the end of last year, surprised everybody with a slightly bigger budget deficit there. Now, the attitude has been a little bit different. The Saudis had pretty much said that they're going to try to cut that deficit quite aggressively going into this year. And in doing so, they're also looking to realign some of their spending more towards what the domestic economy needed, as opposed to some of the big Vision 2030 projects that were currently being planned. So we saw some realignment going on there. But put this pressure on as well, they're not going to be able to export as much oil as they'd hoped. So potentially that deficit is going to become even larger this year. They need to think about what are their priorities. Now, there is enough wealth to look through this shock. If this is a 6-month shock, then they could simply just use their reserves and carry on spending pretty much as they planned at the start of this year. But there is always a risk that they may decide, actually, we need to cut back a little bit more in the very near term, just to make sure that there's enough there that there isn't any kind of concern. The one country I would say the markets are a little bit more concerned about is Bahrain, just because more indebted than the rest of the GCC nations. And we have seen a bit of a jump in credit default swaps, which is essentially insurance against defaults on their government debt. Now, it's nowhere near as high as the likes of a Greek crisis or anything along those lines. We're not at all worried about the situation there, but it was just interesting to see the market react in this way. When suddenly your main source of income is suspended essentially for the time being. Yes, of course, there is a little bit of a concern that there may be a risk of a default, even if it is just a low one.
We've seen the disruption to airspace, of course. The UAE in particular is positioned as a tourism hub, a major global hub, to be more precise. How do you view regional tensions affecting travel demand and airline traffic?
It's huge. It's absolutely enormous in terms of the potential impact, not just for the region, but actually around the world. The number of transiting travelers through the Middle East is absolutely enormous. The whole region has really grown as an important hub to enable long-distance travel. So the number of people I know that have been able to make it out to New Zealand, Australia, because their connecting flights can't land in the region is quite significant. So it's a major problem for these countries. I mean, we estimate, we've done quite a lot of work with the World Tourism and Trade Council, and we estimate that for some countries, the contribution from travel and trade is worth up to 15% of GDP. Pretty big and very sizable, especially for the likes of Qatar and the UAE. Pretty big numbers there. Now, with the travel situation pretty much slow to almost a halt at the moment, of course, there's going to be an immediate negative impact coming through onto these economies. And I guess the bigger question is, well, how long does it last? Because historically, when there has been geopolitical risk in any country, then you don't necessarily see travel and tourism return very quickly. It typically takes 1 or 2 tourism seasons of steady state, everything is okay, before tourism eventually starts to come back. So
sure, there is a confidence here, isn't there?
Yeah, absolutely. People, who are thinking, where do I book my next holiday? They're booking 6 to 12 months in advance. They're not necessarily booking the next week. And if there is any kind of concern about the region, well, they'll go to Southern Europe, they'll go to elsewhere where that risk just doesn't exist.
There is always I don't want to take the party line, but there is a great deal of truth in the Dubai bounce back factor. We've seen it kind of time and again. How do you, in your position, with your economic helmet on, if you like, how do you account for that kind of? I don't know if there is such a thing as a Dubai factor. It kind of feels as though there is. Do you see where I'm going?
Yeah, maybe, yes. There's
a little bit ethereal, a little bit hippy-dippy, I understand, but there's a Dubai factor.
There is a lot of resilience in the economy. I mean, you can see it now where things are generally still open. Yes, there is work from home orders in place, which has definitely reduced activity in general. Certainly, traffic is a lot better now, and pollution is down, which is maybe some of the upside of the current situation. But yes, there is a certain resilience there that would lead you to think that there would be a rebound, and we agree. We expect to see that rebound in domestic activity come through fairly quickly. The international side, I think, will probably struggle a little bit. That's fine. I think that's to be expected, and the economy will have to make do as a result. And then much more longer term, we might see some adverse impact to perhaps international interest in investing in the economy. Maybe not. Certainly, there'll be a bit of a risk premium added to investing in the region, I think, going forward. Okay. Nothing that's, I think, going to fundamentally change the overall picture. Ultimately, the structural story of the UAE and the wider Gulf is still incredibly strong and attractive. I still think there'll be a lot of capital flowing into the region.
We've covered, I guess, energy. We've covered tourism. Any particular sectors exposed to geopolitical risk at the moment that we haven't covered?
Real estate.
How did I forget? How did I miss that?
How?
That's check myself.
Usually the number one topic that comes up when we're in Dubai.
It is.
I understand why it's not top of people's agendas, and that's understandable. But typically, domestically, when we do see big global events, big hits to confidence, real estate does take a big hit. And that's natural because there's such a big reliance on the demand coming through from expats and overseas investors as well, that when we see these kind of hits, you do typically see a bit of a correction in the local real estate market. We have a lot of supply coming onto the market this year in Dubai in particular. And that has to be a concern for investors, especially in the kind of the 1 and 2 bedroom property segments of the market. So we might see something going on there in terms of a bit of a correction, especially as there is a lot of supply coming on. But the rest of the market, I think, feels reasonably solid. I mean, certainly the commercial real estate side, very high occupation rates, capacity utilization is elevated. Not too concerned about that side for the time being. But like I said, there's going to be a bit of a concern around how protected everybody feels about their capital within the region.
I mean, it's been a particularly good couple of years, certainly the last 2.5 years or so in real estate. And we talked to a lot of real estate people who would probably say there is a correction of sorts coming. How strong a correction it is, we don't know. But let me ask you about foreign investment flows into the region. Still holding up despite tensions?
Impossible to say, to be honest.
Really?
I guess the best barometer we've got is the stock markets. And they've taken quite a significant hit. We had a couple of days when the Dubai and Abu Dhabi exchanges were closed, and we had to put some short limits on in order to reopen them to protect it from any kind of big hit. But they are still down quite significantly through this period. So that's to be expected. I think that's very normal in the short term when uncertainty is so high. Investors will trim their exposures to some extent in order to make sure that their portfolios are correctly aligned. But also, of course, if things get worse from here, they need to cover their back. They need to say, yes, well, we did sell some allocation. So naturally, that impact is going to happen. But I don't think it's catastrophic at this point, and it is certainly only a short-term indicator. Long-term investors will behave very differently. They'll be thinking about what is the actual situation on the ground. And as I'm sure you're well aware, Tim, the situation's not that bad here. Nowhere near as bad as other conflicts around the world. In fact, I think if it hadn't been for the lack of traffic, you probably wouldn't know anything is really going on apart from the phone blaring with alerts.
Do you know what's so interesting is the fact that we notice the traffic so much. It's almost belittling the situation, but it is, as you say, it's probably an upside if there is an upside at the moment. There's an element here, I think, of the GCC as a stabilizing anchor of the region. So when you sit back, and I have this image of you, Azad, when you're preparing reports like this and thinking things through, that there are moments when you're furiously typing. And then there are moments when it's hands clasped behind the bed and there's behind the back of your head. And you kind of sit back and think for a while and ruminate. When you do that, just allow me the romantic notion of you doing this. Is there a sense that the GCC economy is almost entering a phase when where kind of resilience matters more than growth numbers?
In the long term, yes, absolutely. I think the most important thing now is to protect the notion of security, because I think apart from oil and gas and tourism, security is a very important commodity for confidence in the region.
Yep.
If these governments are going to be successful in terms of diversifying away from oil and gas over the long term, they need to protect that hard-won commodity of security in the region. Now, we know now that security is being questioned given the current situation. They need to make sure that it doesn't get too bad and the response is quick and effective as well, that people and businesses are protected to some extent through this period and the region bounces back very quickly. And ultimately, this isn't totally in the GCC's hands, but how Iran is resolved in terms of the level of security that's achieved, that's ultimately what's going to determine where we land in terms of the future outlook for the region.
The early signs are, I think, in that regard, seem to me to be, they certainly seem to be positive.
I think most people will currently assume that the war will eventually end with Iran being defeated to some extent. What ends up in Iran is up for question. What does the government look like? Is it going to be a situation as we've seen in Libya, for example, post-war, where actually it's just a bunch of factions and chaos there? Or do we get to see something a little bit more stable like Syria at the moment? These are the kind of, I think, questions that people are currently thinking about because it matters. We were talking about just before the show, we were talking about the apology that came through from Iran, and then suddenly the attacks that followed almost immediately after. That's because there's a lack of control there at the moment, and this could get worse. We don't know which fractions could do what, and who's controlling the army, and who's controlling this. So this is what needs to be eventually resolved, both internally and potentially with the influence of external powers as well.
You're releasing new forecasts this week. What should I be watching with interest in the numbers that you're about to release?
Well, let me give you the headline numbers. For the GCC economies in aggregate, we are downgraded our forecast for this year by 1.8 percentage points down to about 2.6% GDP. That's quite a hefty downgrade. Now, for next year, though, we are revising up because we are assuming, therefore, there'll be a rebound fairly quickly coming through. So second half of the year, we see a reasonable rebound, and that accelerates into next year, and we get a lot of catch-up growth, if you will. Within the GCC, the most negatively impacted economies are Qatar and I would say the UAE as well. Qatar mainly because of its reliance on gas exports.
Sure.
The difficulty there is, whereas oil, you can continue to produce it and then store it and then export it later once the Strait of Hormuz is reopened, gas you can't. It's very expensive to store. And we know from Qatar Energy that they've already started stopping production there. So that production, if you're not producing, that's lost output. That's lost GDP forever, essentially. So they're going to take the biggest hit. The UAE, like I said, they will pare back some of the production. They will export a little bit through alternative pipelines as well. But they have such big exposure to travel and tourism that they're going to take a hit on that side. And again, that will take a long time to recover. Now, the people who are not coming on holiday in the next month or two, they're not going to come twice next year. So again, that's lost output for forever. So those are the worst impacted. The least impacted, as we mentioned earlier, Oman, because they can still export without any issues. And Saudi is less impacted as well, really because they have alternatives in terms of how they're exporting, but also their travel and tourism. Well, their travel hasn't been impacted. Their tourism has. Obviously, people are a bit concerned. But at least logistically, things are operating largely as normal in Saudi.
Two questions, and we've only got about 2 minutes, actually. The next 12 months, the biggest risks, first of all, to the GCC, the economic outlook here in the GCC.
Well, it has to be that the war continues for longer than expected. Because as I said, all of this, the situation all revolves around how long does the conflict continue for and how serious it becomes. It could still escalate further. We could see a situation where Saudi is dragged into this war. For now, they're largely not that impacted. The longer this continues, the greater the impact is going to be on those exporters, especially for oil and gas. But also, I mean, we haven't really talked about this, but the impact on imports as well. For the time being, there are no real shortages of goods, but if you're trying to import something from overseas, at the moment, it's not arriving because obviously the flight situation is disrupted and then the strait is closed. But if it was to last for much longer, we could start seeing shortages of certain goods, maybe even food at some point. And that, of course, leads to quite a bit more inflation that we currently expect. We only expect to see a small amount of additional inflation this year, nothing too serious. But like I said, the longer it goes on, that's when we might start to see more issues.
I like the inflation point there. On the flip side, where do you see the biggest opportunities for growth in the region?
Well, I'm hoping that all of this leads to a re-emphasis on the need to diversify away from oil and gas. We've done quite a lot towards tourism, but I think it strengthens the case to think about alternative industries as well. So we know that the GCC economies are, really looking at artificial intelligence and building out the capacities around that. That would be great, I think, because if we had a bit more industry around there, then the impact on GDP from this current situation wouldn't be as severe. So hopefully we will see more concentration, more focus on delivering that diversification.
When's the report out? When are the forecasts out this week?
Forecasts will be sent out to the clients, I think, on the 10th of March. Our report should be coming out in the next couple of days or so.
Okay. Well, we look forward to hearing more about it. Azad Zangana is the head of GCC Macroeconomic Analysis at Oxford Economics, with us at Mirror Business FM this morning. Appreciate your time. Thank you.
Thank you.
Fascinating indeed. Mirror Business FM, this is The Morning Drive.